account. So when we go to the part taking, this is an income statement. So if you look at the receipt and payment, you have been given the part taking on a debit side of 40,000. So we will credit that 40,000 in the income statement. And then we go to the part of the cost of sales. Cost of sales comprise of what? It comprises of the opening balance of the inventory, which in our case, we have the per inventory of 880. And then given these purchases, we remember that this is the value we got it from what? A payable account. This is from the payable account, which is 30,000. And then eventually we have been given to the per inventory of what? For 1440. So this will give us the total cost of sales of 29,440. So when we take the sales minus the cost of sales, we arrive at the gross profit. So we have our gross profit of 1050, 10,560, 10,560. And if there is no other incomes, we go straight and subtract expenses. And you must be keen here. The only income and expenses which we account for the per income statement is the one with the name per income. So we have the bar wages, which it has an accrual element. In the receipts and payment, we managed to pay 2,800, but in the statement for the current year, in the assets and liabilities, we have accrued wages of 600, which we add back the accrual. So the total will come to 3,400. So we take the gross profit of 10,560 minus 3,400. We arrive at the net income of 7,160. So this 7,160, we are going to credit the income and expenditure account. We are going to credit the income and expenditure account. That is our next move. So the income and expenditure account, we can start with the credit side, which is the income. We had opened the subscription account and we got a balancing figure of 27,600. That is at the beginning. And then we also opened the per income statement and we got this one as our net income. We credit that one. But from here, we have a donation which we extract from the receipt and payment on the debit side. We have a donation, that is an income. And then we have sales of magazine. Magazine also is an income. That is the part of their segment of their revenue. They sell a magazine. So that is an income of 32,200. We have the competition ticket. Maybe for entry, those tickets, they also part of their incomes. So we credit 7,200. And then we have the investment. Investment, go to the note number 1. We have been told the 10% of the investment is an income and they have not been paid. What do? We account as an income and also we account as our current asset. So we will take the 10% of the investment cost of 40,000, which will be able to get 4,000 as our income. 4,000 our income. We have the profit on disposal. How do you calculate the profit on disposal? You have to check at the net book value of the asset and the cash proceed. So we check. So if the cash proceed is higher than the net book value of the asset, then that is a profit. If it is less, then that is a loss on disposal. But in this case, it is a profit on disposal, which is 800 is the cash proceed and the 600 is our net book value, which will give us a profit of what? 200. If it was loss, we could have bring it in the debit side. Then you go to the debit side. Debit side is for the expenditure. Number 1 is the depreciation. In that note, we have been told the depreciation is 10%, but on a reducing balance basis. Remember, we have 2 methods of calculating depreciation, straight line method and the reducing balance method. So when you are asked to use the reducing, we use the net book value. And the key note here you must take is that whenever you have been given the 2 financial years, then automatically those values are in the net book value. So we will take the net book value of 2023, which is 20,000 plus the acquisition of a motor vehicle, which is there in our receipt and payment on a credit side of what? 26,000. So if we add the two, we'll be able to get 46,000. Then we multiply by the rate of 10,000, 10%, which give us depreciation of 4,600. Equipment is the same. We have the value in 2023 of 14,400, but in the note, we have been told they disposed an equipment with which had a net book value